Hi, I'm Seth Freuberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB Capital's Options Trading Desk. So today I would like to talk about a trader's pre-market routine. Professional options traders, whether you're trading your own capital or trading firm capital like the traders here at SMB on our options desk, in either case, you need to have a plan for how you're going to manage your day. Trading is a business, and in any business you need to be organized, you need to be prepared, otherwise you're not going to succeed. And that is no less true of trading than anything else. So I want to talk about the routine that our best traders use, the best practices of our best traders, and hopefully that will help you to improve your trading. First of all, you need to be aware of the market every day, and it's not good enough to stroll in at 9:30 and turn your computer on and open up your broker platform. That's too late. For you to be aware of what is going on in the market, you really need, in my opinion, at least 1 hour before the market opens. So 8:30 Eastern Standard Time should be the latest that you become aware of how the futures are trading and how the other overseas markets are trading overnight, to give you some idea of what the U.S. Open will be about and what the trading will be about, at least what it appears to be pointing towards. So I suggest that you become aware of the futures in whatever you are trading. Most products, whether they be indexes or commodities, have futures products related to them, and you should have a subscription to that data so that you can watch the futures for whatever you are trading. That's really very important. If there's at least in the indexes a 0.5% move or more going on in the futures overnight, that's significant, and that means you need to be more than the average prepared for your market trading day. Now, once you are preparing, and in that hour that you have to prepare, you should establish a game plan for every one of the trades you have on. If you only have one trade, well, I guess that's pretty easy. But if you have multiple trades on, like many of us do, then you need to establish a plan for each trade. If you have trades on in multiple months, you need to have a plan for each trade in each month. And what's very important is that you establish both an upside plan as well as a downside plan. Now let's say the futures are pointing downwards, that there will be a sell-off that day. Some traders will have a tendency to only prepare a downside plan. Well, that's a fallacy, because the futures can be wrong. They often are wrong, and the way the market opens is not often the way the market closes. So you need, when futures are pointing downward, it may be that day will be a very large rally by the end of the day for some reason. There could be lots of reasons a market could rally, but whatever the reason would be, you need to have both an upside and a downside plan. And there's a subtlety in that, and that is, if you establish both an upside plan and a downside plan, then you're admitting to yourself that where the futures are pointing in the morning does not necessarily mean that that is where the market will end up at the end of the day. You're being properly agnostic, I guess you'd call it, for an options trader, and therefore by establishing an upside plan and a downside plan, no matter how improbable you think one of those sides is, it forces you to understand that the market could go in either direction, and you need to have a plan for it. So it's very important. And I will give you a good example of that. Yesterday was the biggest down day in the market in 2017. And that was not the way the market opened. The market actually was rallying at the beginning of the day, and the futures were pointing towards a rally as well. And so if you had only established an upside plan for your trades yesterday, you would have been scrambling. Now, the next thing you need to do once you've established your plan is to actually set the trades up in your broker platform. So if the market goes in a certain direction, calls for you to buy a vertical spread, or to buy a long call, or to buy a butterfly, or whatever, you should actually set that up properly sized in your broker platform. Why? Because if in the middle of the market day you are forced to set the adjustment up, or the position that you're adding to your options trade, you'll be forced to set that up on the fly, and you can make mistakes. You can size it incorrectly. You could do calls instead of puts. You could make all sorts of mistakes if you're scrambling. But if you have it prepared and you have the order ticket ready and it's simply a matter of executing it, it gives you a much better chance at not making execution errors and not scrambling. Remember, oftentimes when you're doing an adjustment, the market's moving and you may be a little rattled anyway. And so if you do things in preparation for the market so that you are rattled the least, then that's a good thing. Now, the next thing you should do is have a sequence written down, so that if what you're doing, and this applies primarily to complex moves in your positions. If you're doing a complex move, then you should have a sequence written down. You should know how much the deltas are being affected by each portion of the adjustment, and then you should do them in a sequence so that you're as delta neutral as possible while you are executing the adjustment. And so in some cases, oftentimes when you're exiting a trade, for example, you have a really complex sequence, and you need to write it down and you need to execute according to that plan. If you don't do that, you will find mid-trade, mid-exit, for example, and possibly a very successful trade, you can lose half of your profit exiting the trade if you don't exit in a delta neutral way, so that you are taking the risk off the table in a certain sequence to be agnostic to the market. So that is very, very important, to have a sequence for complex adjustments mapped out before the market opens. So another very important point is that every trade should have an intraday adjustment point and an end of day adjustment point. Why? Intraday, you can respond. Sometimes the market can move very, very rapidly intraday, but typically you'll get more gradual movements, and you can respond during the trading day with an adjustment. But sometimes overnight, events happen in the world which cause a gigantic rally or a gigantic sell-off at the open, and you do not have the ability to react because the market's closed. In those circumstances, you should have a more conservative overnight plan than you do an intraday plan. So if you are, and by the way, if you are near your max loss, you must take that max loss. That is really a whole video in and of itself, the discipline of taking your stops, but you must take your stop. And if you're planning your day and you're near a stop on a trade, you have to know the point in the trade where you're going to have to exit. You need to estimate that using your options analysis software, exactly what price point would cause that, and you need to then go ahead and exit it, and your exit has to be established using all the planning that I just mentioned for a normal adjustment. So what's the moral of this story? The moral of the story is trading is a game of discipline. If you don't have the disciplines to trade, you will not be successful. That's true in trading, and that's true in every other walk of life. If you have to scramble to respond to something that's going on in the market, it creates a chain of events that are all bad. You get rattled, you will probably get terrible fills, and you will very, very often, and probably the biggest issue with scrambling is you will make mistakes. You will enter the wrong trade, or you will enter the wrong size. And so if you're scrambling, it's not the right state of mind to effectively execute an options adjustment. If you are, on the other hand, prepared and you've set the order tickets up pre-market and you are aware of what's going on in the market through the futures market, and you have created a sequence for a complex adjustment, then you're prepared. Then you've practiced essentially in your mind so that when the event comes up during the market day, you can just pull the trigger on this very, very effective plan that you put together because you have the discipline to have developed the plan in the first place. If you're organized, if you have a plan, if you put the work in to be prepared for the market, you can be a professional trader for the long term. If you don't, then you're basically gambling, and trading is not gambling, trading is a business, and you will not be successful long term if you're gambling. So prepare for the market, have a good, solid pre-market routine, follow that routine, and you will heighten your chances of being a successful professional trader long term. Thanks very much, and we'll see you next week.